Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. It's great to be with you as we close out 2021. I'm Eric Auskerson, one of your hosts for today, and we've got another power hour in store for you. We're going to be covering some of the latest news from Washington, D.C. We're also going to do an economic outlook and talk about some key technical updates that will be important as you close out this year and move into 2022. So here's the agenda. I'm going to kick things off with Barry Melanson, and then I will be introducing these other presenters as they join us today. So welcome, Barry. Barry, this is our 65th town hall as we close out 2021. We'll be talking a little bit about that later in the show. But what we want to get into now is what's happening in Washington, D.C. and on the December 7th town hall. You predicted that this was going to get pushed out into 2022, and Manchin kind of announced that on TV last weekend.
Yeah, Eric, I think first off, 65, there are some good things that COVID has brought for us. This town hall series is one where it's an opportunity to interact with members throughout the country and all different backgrounds, and the feedback we've gotten is fantastic. And as you said, we'll come back to that. Yeah, last week or 2 weeks ago, we said, there was a slight possibility that it could happen in December. Deadlines like a holiday have been traditional deadlines. And that can cause things to happen. We had a debt limit issue that was out there at that time. About a week after our last town hall, there was a somewhat convoluted deal that was made on the debt limit that allowed it to get passed, really pushed off to 2023 now. That sort of took away that deadline. And we said there was a chance that it would be before Christmas, even a smaller chance between Christmas and New Year's. But clearly, we thought the biggest chance was a January of 2022. Now, with Senator Manchin, sort of releasing his statement on a newscast over the weekend on Sunday, we really sort of ramped up the rhetoric. And we've all seen the quotes, we've heard the comments, and you saw very early on sort of the denial points where people were just attacking him in his own party. You sort of heard him talk about some of the things that he didn't like. You specifically, his quotes really focused on some things, focused on the White House staff, not the president. I think the president also had some commentary that was, we can still get this done. And I think if you read between the lines, you really start to see an element of there's going to be another attempt. But really, if you take a look at it, and I think when I look at all of this, it really points to our system today. Our system of government is built around checks and balances. That's what our forefathers gave us. And some of the rhetoric in this process on both sides of this issue are pretty counterproductive. Like, for instance, where our government is so divided today, there's almost this insistence that everybody votes lock stock with their sort of notion of their party. You have to be with your party. And the ability to compromise, which we all know from a business perspective, all of us on this town hall, that the art of compromise, to quote the former president, but more realistically, the notion of business compromise is really important. And this is about the business of the government, a business of our country. And that ability to compromise is rarely seen. We did see it in the infrastructure bill, but when a member sort of goes against their party, the sort of almost the hate that comes out of that process is pretty significant. And our country has been at its best in history is when we do reach compromise and people are not just voting along all party lines. And Senator Manchin, along with Senator Sinema to a lesser degree now, but Senator Manchin, sits in a very important role of being able to really try to look at some of those things. And there are things in the bill that he doesn't like. Some of the ways that the child care credit is being considered. Not that he's opposed to child care, apparently, but that it's just sort of he thinks there needs to be some modifications, and some of the other maybe social policy issues that are in this bill that might not be apropos. I think regardless of whether you see it as something that should pass or not, and everybody's entitled to their own political opinions on that. I think the bigger issue is how do we get back to a government that can have dialogue that doesn't, really, overplay some of these points and try to get to some compromise. Social media works against that, and even some of the statements like you saw where the government is broken if one member of the Senate can control this issue. Well, it's actually 51, right? And the American public understands that. And I think if you could really, really engage fully with the American public on polling of different issues than on a particular topic matter, I think a pretty significant amount of the American public wants government to work. And that means probably better dialogue and maybe mirroring some of the things that happen in business in the way that compromise is reached. Unfortunately, we have extremes on both sides that make that very, very difficult.
Well, Barry, great summary there. We got a number of questions coming in. One is just on, retroactivity. So now, it looks like it's going to go into 2022. What happens with some of the dates related to, the tax changes?
Right. Well, I mean, it's not only retroactivity. That's a big one, and I'll comment on it. It's also what about some of the things that were in the House bill? Do they go away? For instance, we did not have a capital gains tax rate change in the House bill. Does that get traded off in some kind of way on other issues? I think the retroactivity is going to be a very big issue for all of our members as it relates to their clients or to their employers. That becomes much less certain. We were looking at a fact pattern that said, January 1 was going to be the cutoff date or the implementation date. Our tax team right now is working on a series of like the 5 most critical items to be addressed that would not work with retroactivity as an example. And we're going to be heard from that standpoint. Congress is going to listen to us on that particular point. It requires a lot of work by the congressional staffs if the bill starts to get evolved. I think there will need to be some prospective effective dates because some of the things just will not work very efficiently with a January 1 date once we get into January. And I think it's very important to understand there's no certainty it's a January date. The next sort of point is the funding of government, which is in the middle of February, which, there was that deal that funded government as well. That's the only sort of natural fiscal element, and that's not a big, strong one because continuing resolutions can continue to push that forward. This could drag out a lot. I mean, there could be a deal cut, but it could drag out a lot. And then effective dates really, really become even more complicated. Clearly, if a change in the capital gains rate comes back in, that would be a big one because all of your clients or your employers are saying, what about transactions that are going to take place in January? How am I to look at that? I think this Congress, look, it's hard to predict, and you can't take this absolutely certain. But Congress was pretty sensitive as the bill moved through the last really 6 months of the year to be very sensitive until how effective dates work. And that's going to be really, really, really critical component of what we're going to be messaging to Congress now that it's clear. If anything passes, it will be into 2022.
So Barry, anything else here, just kind of on the legislative outlook, where the different items that they're looking to advance here, and just what happens if things move into the second quarter as the year moves further along.
I think the further it moves, the more sort of fuzzy it becomes as to whether you have any particular bill. You have a situation in which there are a lot of members of the House, particularly the progressive wing of the Democratic Party, who feels like they voted for an infrastructure bill on a promise of getting this through the Senate. And clearly Senator Schumer promised that. So there will continue to be a lot of significant push, I think, in that area to get a bill done. I do think, for instance, some of the social issues, as you recall, we discussed the Byrd rule that of anything that gets voted on in the Senate on this, to get it to be a 50-50 passage where the vice president breaks the tie, the bills the provisions have to meet the Byrd rule. The parliamentarian of the Senate had already ruled against a couple of things as being non-germane or fitting under the Byrd rule. I think we'll see some of that play out again. Look, you could see some trade-offs. For instance, you could see the corporate minimum tax that is in the House bill. That could go away. There's a lot of complexity to that. Again, a lot of pressures on what book income would be under that process. The trade-off from a monetary perspective probably becomes some movement by a few points on capital gains. Then we're back to the effective date issue. Those types of things I think you can see move as the negotiation moves forward. And frankly, depending on how Omicron sort of progresses into January, you're going to have some more debate about the issues of is there a need for government support, particularly for small business again? How that might get wrapped into this discussion is a big unknown. I think that has a lot to do how COVID really looks into January of this year, of 2022. I'm sorry. I think that could be a trade-off as to where certain things go. Generally speaking, though, I think the bill shrinks in order to get a compromise to move forward. Senator Manchin has expressed a lot of distaste for some of the phase in and phase out provisions as a way to make the price tag work. You probably will see a narrower set of issues, probably with more permanency to them, if anything does pass through this particular process.
Well, Barry, we'll be unpacking more of this on January 6th. We'll definitely have that update from the tax team by then, and we can kind of get into more detail about some of the potential impacts related to this legislation moving out. Related to one other matter before we bring up Marcy Russell, some really good news here.
That's right. A lot of our members, particularly those that first service clients in the 6 states that were designated emergency states as it relates to particularly Hurricane Ida, there was this procedural aspect where the IRS had to close the system down, but then you had an extended due date to January 6th, I think it was. That was going to fall right into when their e-filing system was actually closed. Our tax team was fantastic in making the point about this is very, not very practical. You're forcing paper-based returns, more backlog problems at the IRS, et cetera. And just this week, in fact, the IRS issued a ruling. The ruling is in the resource section, the notice, I should say. If those of you who have not seen it, pushing it to February 15th, that really creates an environment which we believe now all of those returns can be e-filed once the system is back open in January. So good work by our tax team, and I think good work by the IRS to being sensitive to this.
Yeah, great to see. So now let's bring up Marcy Russell, who has been on past town halls, and I've got an exciting announcement. We've listened to a lot of feedback, and we're going to have Marcy joining us quarterly here on the Power Hour for the Profession. She used to be the co-host of the Squawk Box. Sometimes we like to call this the Squawk Box of the Profession, and there's never been a better time to really be understanding, where the economy's going and how to think about that as these firms are supporting their clients. So welcome, Marcy. Great to have you. And what we're going to do is we can drop the slides. We're going to first kick this off with a little bit of a look back on 2021. When we had you in the spring, we were talking about potentially 7 to 10% growth. That was before Delta. That was before the inflation concerns. So why don't you look back on 2021 and give us some of the key takeaways, and welcome again.
Well, thank you, Eric. Thank you, Barry. Thank you, everyone, for having me back. It's fantastic, and I'm looking forward to being with you this year, 2022, because when I think about 2021, if I wanted to just summarize it, I would say that we went from a situation where the U.S. economy snapped back dramatically over the course of the year. Now, yes, we were anticipating 7-8% growth. We didn't come quite that high, but this was a year where the U.S. economy grew very strongly. In fact, the U.S. economy and the Chinese economy grew at about the same rate, which is really remarkable, when you think about it. And we're going to talk a lot about what's going on. I think we should touch on what's going on in the Chinese economy. While our growth rate snapped up, their growth rate came down. But in the U.S. in particular, we saw that strong growth because it was so much fiscal stimulus in the pipeline that translated into a ton of consumer spending. And then that consumer spending led to quite a few shortages. It led to some price spikes in quite a few industries, We saw supply chain disruptions, which all came together to produce inflation rates like we haven't seen in about 40 years, quite frankly, since I was in middle school, right? So if you think about, that's a really different deal, right? I mean, that was really what we were expecting early on. And so I think that inflation is really what defined 2021. But I'm going to go out on a limb today, and I'm going to say this. I think inflation peaked in November of 2021. And right now in December, we are living through a situation where the main drivers behind inflation are really shifting. And I think what we will find looking into 2022, that the story is going to be that inflation peaked in 2021, and that we're going to see some real moderating influences on inflation going into this year.
Well, Marcy, what we're trying to do here on the town hall is bring the best available information, at times make predictions. So that's quite a prediction that if you heard it here on the town hall, the AICPA town hall, that potentially inflation is peaking. So why don't you unpack that? I mean, you shared a slide. We can bring that slide up related to how you're thinking about the drivers behind why this could be the peak.
Sure. Well, I think there are two things. The first one is domestic, and it has to do with energy production in the U.S. So in that slide that I'm going to sort of show you, this is the U.S. oil rig count. So this shows you active rigs that are pumping oil in the United States. And if you look back to the early phase of the pandemic, what you can see is that production in the US was cut aggressively. So in the early phase of the pandemic, when businesses were closed down, no vaccine was on the horizon, everyone was anticipating that economic activity worldwide was going to shrink dramatically. And it did in March, April, and May of 2020. So the oil industry in the U.S. cut back production. The shipping industry worldwide cut their capacity by 11%. U.S. automotive companies anticipated that they weren't going to sell any cars, which they ended up selling quite a few cars, so much so that they don't have any inventory right now. But the point I'm getting to is that early on, everyone was forecasting this enormous dip in economic activity. And that did happen, but what they didn't anticipate was all that government stimulus, how quickly people would increase their spending once they sort of became comfortable with this new environment. And instead of spending money on services, which are still sort of below what they were prior to the pandemic, people shifted their spending to hard goods. They wanted new refrigerators. They wanted a new car. And once they started traveling again, they were starting to fill their cars up with gasoline. And so that oil rig count showed that big dip initially, but it's starting to come back. And so oil production in the U.S. Is still far below what it was because it takes time to turn those rigs back on. It's easy to turn them off. It's quick to turn them back, it takes a long time to turn them back on. So the rig count's coming back very, very slowly, but every single month, you add 10 rigs, you add 20 rigs. And you can see it right here. We're back up to about almost 600 rigs. Now that's short of the 900 rigs that were running prior to the pandemic breaking out. So it's going to take a few more months. But I think that's going to be the story. That's part of the story, is that rig counts come back and that slowly drives down the price of oil. That's already been happening in December. The price of oil peaked in November at about $83 a barrel. It's now come down to about $72 a barrel. That's West Texas Intermediate. That's the price today. More importantly, the price at the pump in December is already down about 10 cents a gallon. That's nationwide averages. So all those energy price increases that were driving up inflation in 2021 are now turning in the other direction in December, and I expect those trends to continue in January, February, March, into the first quarter of next year. The other thing that I think will blow some deflationary wind onto the global economy is the slowdown of the Chinese economy. So if you think about China's voracious appetite for all sorts of building materials over the last 20 years. Cement, steel, anything related to the building industry. It's been supporting prices across the board for all sorts of primary materials at the producer price level. And so the slowdown in China that's sort of building in their residential construction, and we all know from US experience that if you have a bust in your residential construction sector, that's going to reverberate across your entire economy. And that's going to be, I think, the story in 2022 for China. And that's going to put some deflationary pressure on production in the US. So oil prices, energy prices coming down, deflationary forces from China because their economy slows down. I think that's going to mean inflation. We've seen the peak of it in November of 2021.
So Marcy, that's a great summary, and I think the China influence is certainly there because we know their sort of real estate, residential real estate has been a big issue. But if we think about the people in this town hall, and most of them, their clients are small business, or they work in small or medium-sized business. And as you know, I'm a big believer on, small business being the key to the American economy because it's just such fundamental to our psyche as Americans. Maybe you can help them think about, what to say to their employer, to their clients, because it's sort of like a four-legged stool that I think people are communicating about today. Inflation is one you just talked about. People is another, which is a big concern from that standpoint. Supply chain, just in general, and I mean, you touched on it to a large degree, and maybe to a lesser degree, tax, because those are the big things that small business, when they're sort of running their activities in some form or fashion, are really focused on as an entrepreneur.
Well, I think let's talk about the supply chain issues in particular, because I think the supply chain issues, like the inflation issue, probably peaked in the fall of 2021. Now, in construction, in particular, I do know that in construction, what I'm sort of hearing on the ground is you still have 2, 3, 4 month wait times for some basic construction materials. A good friend of mine's in construction, he said, I can't get a garage door for 4 months, right? So you still have some lagging issues there, but I gotta tell you, the early reports from the holiday shopping season suggest that the worst case scenario that we were expecting, there just weren't going to be goods on the shelves, nothing to buy this Christmas, that really didn't materialize. And it goes to this idea that I come back to and have through my entire career. If you're anticipating a problem, it generally doesn't turn out to be as bad as you think it's going to be when it comes to the economy. It's the things you don't anticipate that turn out to be terrible. And so we've been talking about supply chain issues for 6 months now. People have been talking about it and talking about it. And so if I can see that problem coming, it's remarkable how higher prices fix some of that problem, right? Higher prices fix demand issues because people make different choices, and that alleviates some of the supply chain issue. So I think supply chain, inflation, those two things peaked fourth quarter of 2021. When you get to the labor issues, those are much longer term. And I know Eric and I sort of want to talk about that in depth here in just a few minutes. So I don't want to get to that too soon.
I just want, it's a live show here. So we got questions. Definitely, we've got a debate going on out there about the interest rate prediction. And Barry, I'm going to clarify, this is not an AICPA statement.
That's right.
It's our economist, Marcy Russell, with her analysis. And we appreciate that. But talk a little bit about the Fed rate and interest rates and how that goes into the inflation and how do you see that folding out? And then we definitely are going to move into discussing labor. But let's talk a little bit more about the interest rates and inflation.
Well, if you think about how Chairman Powell has been saying over the last year, I think the inflation's transitory. I think it's transitory. He's really been sticking to that line. Now, October and November in particular, he kind of backed off and said, hey, we might raise rates faster than we thought we were going to. I think that December number and the January number, which are not going to come out until first quarter of this year, it's going to take some of the heat off of them in terms of raising rates. So I am expecting like the markets are, I'm not making this up, the stock market is expecting a couple of rate hikes next year, but we're coming off of 0. So the Fed takes short-term rates up to 50 basis points next year. That doesn't necessarily translate into higher long-term rates. And even if it did, I believe the economy could handle higher long-term rates. Growth rates are so strong right now that 100 basis point increase in the interest rate environment, that's not going to kill off economic activity. This is not the 1980s. Now, I'm guessing many of you have sort of lived through that experience and remember the Fed jacking up rates, right? Exactly. We're not talking about an increase of 500 basis points. We're talking about 100 basis points. I don't know that that's going to make really much material difference for the way business runs in America, over the next year or two.
Well, let's pivot to talent. Talent is a big issue. You and I did talk about this, the talent issue with the firms, the labor issue, employment issue with businesses of all sizes. It's very interesting what you said just about the supply chain, the technology. Basically, technology is going to help solve this. I remember when we were speaking, you talked about how in 2015, all the fracking, again, technology came in and help address some of the oil price issues. So that's interesting. But what is the talent issue, and how are we going to manage the talent issue, and how do you see that unfolding over the year to come?
Well, I got to tell you, we saw talent issues really break into the headlines as the economy snapped back and everybody turned around and went, my business has come back, but I can't find anybody to work. And everybody said, well, extended unemployment benefits, which from an economic point of view, obviously provide a disincentive to work, because if somebody gave me money, I wouldn't work, even though I love all of you guys, right? So we know that's a reality. But there was this expectation that once you cut off extended unemployment benefits, that everybody would come back and suddenly the labor issues across the economy would ease. That's not been what happened. Now, the reason is, I got to ask everyone who's listening right now, did you have talent issues before the pandemic? Be honest. I bet you did. You did. So there were issues before the pandemic, but what the pandemic did is that it basically severed millions of people's connections to their job, their employer, and their geography in a really short period of time. So when you do that, taking millions of people who we know will stay in situations that they absolutely hate because change is worse than anything, and you force them to change, you're not going to put all those pieces back together very, very quickly. That takes time. On top of that, there's two broader demographic issues. The pandemic escalated retirements of the baby boomers to the tune of about 1 million extra retirements above and beyond what we would expect, because the value of their houses and the value of their stock portfolios were 20% higher than what they thought they were going to be. And they said, you know what? I don't like this Zoom thing. I'm going to my fishing, shack, right? So you got that problem on that end. But then on the young end, there's a demographic decline from the millennials to the Gen Zs, a big one, of about 400,000 every single year. So 10 years ago, every year, there were 2.8 million millennials hitting the job market every year. Right now, there's only 2.4 million Gen Zs hitting the job market every year. So if you're looking around and going, I can't find young people to work, the response is they don't exist. There are 400,000 fewer of them than there were a decade ago. And that problem doesn't go away, except unless sort of we all get busy and 18 years from now, we produce more people.
And one other data point.
That's right. There you go. Wall Street Journal, U.S. Census reports lowest population growth on record. So this doesn't get any, in fact, it gets worse in 18 years, right?
And Marcy, there's another point on that. There is a different attitude towards, particularly for those clients or employers, or certainly in our profession, the whole university and education process, which certainly took some body blows at all levels of education. There's some data that we have that shows that the total undergraduate enrollment, the fall semester of 2019 to the fall semester of 2021, so that's a 2-year gap, is down over 1 million. When the final numbers come out, there's some indications that it will be closer to 1.5 million less students in undergraduates collectively, all majors, in the United States. And that's a really significant long-term impact if that doesn't reverse as well, as you look at the types of jobs that the people who do come into the area actually move into.
Sure. Well,
maybe just maybe the closeout. Maybe that phone is calling in a question here for us.
right, that's exactly what it is.
But what will so comment on that, and then just kind of a closing remark as you look out at 2022, economic growth in the stock market. Just you look a little reflection on the last 2 years and how you see 2022 unfolding. And remember, we're going to be bringing you back in March.
I know it's a little bit scary, isn't it? I got out on the inflation limb. We'll see if I was right or not. Barry, it's in terms of college enrollment, it's demographics, but it's also the foreign students drying up. So a lot of U.S. Colleges had sort of kept their seats full by pulling students from abroad. Well, of course, the pandemic sort of brought that to an end very, very quickly. So hopefully that will come back as sort of this moves from being pandemic to endemic, which is kind of, I think, the headline right now. But as I look into 2022, I think you're going to see less inflation. I think you're going to see less aggressive Fed than maybe we thought a month ago, right? Because inflation goes down. And I think it means that you get a pretty regular year for the stock market. So I'm not expecting another 20% gain, because a lot of that 20% gain was just a snapback from a 40% decline early in the pandemic. So all of that washes out. And I think from a stock point of view, we're looking at a really, much more normal returns, something more like in the 5 to 7% range, because that's just the average, right? So I think you're going to get a much more normal year next year for stocks. But I am a little concerned, right? I think some of the things that we're going to watch on this show are what happens to things like speculative investments like Bitcoin. Where does that go? Where do the meme stocks, where do all these sort of abstract sort of NFTs and things like that, how does that develop as the year goes on? Because that's been an integral part of what's been sort of driving markets over the last year and everyone's enthusiasm for markets. I think it'll be interesting to see how that plays out in 2022.
Well, Marcy, thank you so much. It's great to have this partnership with you, and we're formalizing it, and to have you on this town hall quarterly. Lots of questions, which we unpack, and we'll thank you for all the questions here. And we will be leveraging them as we move forward in 2022. And one topic that is coming up is how do you address the talent issue? Technology. That's something that I look forward to getting into further with you when you're with us in March. So thanks again. Have a great new year. Thanks for being with us. And Barry, we'll bring you back at Open Forum. We're now going to bring Lisa Simpson up for some important technical updates. So Lisa, I'll let you take it away.
Thank you, Eric. Marcy is such a hard act to follow. So boy, here we go. Let's talk about SALT. That'll be exciting. What we wanted to do is bring to your attention a couple of tax issues as we approach year end. And the first one is state and local tax payments for pass-through entities. There's a really good article in the Journal of Accountancy that I wanted to call out for you that talks about some of the issues around the interplay of that $10,000 SALT deduction that was part of the Tax Cuts and Jobs Act, and then an IRS notice that came out in 2020 that gives some wiggle room in terms of pass-through entities paying tax at the entity level, and then helping minimize the impact of that state and local cap at the personal level. So there's some ambiguity in the language between the act and the clarifying notice that the IRS put out. So what we wanted to just provide to you is what we're hearing from most of the CPAs that we're talking to, is that they are advising their pass-through entity clients that if SALT at the entity level is an option, if paying those taxes is an option at the entity level, that the most cautious thing to do is to go ahead and pay that before year end. There are some specific tax or state tax differences. So for example, the treatment in New York or the timing of New York versus California is different. So we've outlined some of those things for you to consider as you get ready for year end. And again, I'm going to point you to that Journal of Accountancy article for a good overview at some of the thought process around why CPAs are recommending that those taxes get paid before the end of the year if it is an issue for those pass-through entities. So we've got that. And then if you remember way back to March of 2020, when the CARES Act was passed, there was an election, or there was an opportunity for employers to defer their portion of the Social Security taxes. And then their portion would be paid in 2021 and 2022 at year ends. So now we're at the end of 2021, and we wanted to highlight some mixed numbers around how the amount of the 2021 payment is being calculated. So your client, if they did this deferral, should have gotten a notice from the IRS that indicated the amount due at the end of each year. But some were surprised that it wasn't just half of what they thought they had deferred. So there was a little nuance in there around how much the employer actually deferred versus how much they were eligible to defer. So they gave us some examples that we've highlighted on the next slide for you. And they go through a couple of scenarios. First one's super duper easy. It makes sense. It's 50-50. But they give another example of an employer who made some of their tax payments in 2020 and then did the deferral. So we show you how they've calculated the amount that's due at the end of the year. There also was a little glitch early in the process around the IRS actually applying ERC to that deferred payroll tax amount. Our advocacy team contacted the IRS about that and got it fixed, but you may have some clients that were impacted by that, which changes the amount of that 50-50 between 12/31/21 and 12/31/22. So again, look for that IRS notice that your client should have received. And then we've given you links to a couple of resources from the IRS if you have additional questions around that. So year-end tax reminders for you. Another issue that we wanted to talk about is accounting for leases. So for that conversation, we're going to have Bob Durack, who's the director of the Center for Plain English Accounting, join me. Bob's been on here before. He's done some accounting for PPP videos for us. If you haven't seen those, I would highly encourage you to go check those out on our PPP resource page at aicpa.org/PPP. I can't remember anymore. It's been so long, I've forgotten how it goes, but we'll have the link in the resource slide. Bob, thank you for joining us. And I know that you and the technical hotline and the folks at the Center for Plain English are getting questions from practitioners about how to actually implement the new lease standard. So can you just start by giving us a quick refresher on what the difference is between the previous standard and the current standard?
Yeah, certainly, Lisa. And thanks so much. It's great to be back with everyone on the town hall. And I appreciate the opportunity to talk about this standard because this standard is a big deal. And it's going to create a major change management process at many companies to deal with it. It's going to result in a material entry to the balance sheet for many, many entities. So my goal here today, if nothing else, is to encourage everyone to get on this standard earlier rather than later. As 2022 kicks in, please start getting at this standard, implementing it at your clients, at your companies sooner. Don't wait till later in the year. So as Lisa said, let's just kind of cover an overview of what the new lease standard is all about. It was issued back in 2016, and it exists in the FASB's codification in Section 842. And what this standard does is it requires all leases to be recorded on the balance sheet. So all leases are coming on the balance sheet. Now, if you think about what prior GAAP was, what prior accounting was for leases, and that's codified in Section 840, we had two classifications of leases, operating leases and finance leases. We still have that basically today under the new standard, where the new standard has a category of operating leases and what they call finance leases. So we don't call them capital leases anymore. We call them finance leases. But under the old GAAP, only capital leases were recorded on the balance sheet. Operating leases were not. Under the new standard, all of those leases, operating and finance, will be coming onto the balance sheet. And this is going to impact many, many industries across the board. If you have a lease, you're going to be impacted by this standard. So there'll be a balance sheet impact for many, many entities. Income statement, not as big of an impact. The P&L treatment under the new standard will depend on whether or not you're dealing with an operating lease or a finance lease. It's an amortization and interest model similar to what we're doing today. And I also want to highlight one more thing on this slide. Don't overlook the disclosures. There's many new disclosure requirements with the new lease standard, quantitative and qualitative. Sometimes we can overlook those and then be kind of caught off guard with all the work and effort required to aggregate the data for those disclosures.
That was a great summary of current versus new. So you've been looking at some of the implications that you're already seeing, because some of this has been effective for public companies already. But when is the effective date for private companies?
Right. So public companies already dealing with this standard. Public not-for-profit entities, conduit debt obligors, they've had to implement this standard earlier. But for private companies, for private not-for-profit organizations, so we're talking about a vast amount of entities out there. Calendar year 2022 is when this standard is kicking in. So that means as of January 1st, 2022, there will be a material entry made on the balance sheet of many private companies and not-for-profits out there to bring those leases into the financial statements onto the balance sheet.
So the day has arrived, basically.
Yeah. Right,
okay.
Right.
So if we go to the next slide, then let's take a look at what you've identified as some of the highlights when you're analyzing the new standard.
Yeah, it's it's pretty commonsensical to figure out which industries will be more impacted than others when it comes to the lease standard. Just think of companies, industries that have lots of leases. So a good example would be chain stores, retail stores, grocery stores, drug stores, even banks and telecommunication companies. Those are industries that will be more impacted than others. But again, if you have leases, you're going to have to address this standard. I will mention, though, and I meant to mention it earlier, Lisa, that there is a short-term exemption in the lease standard. So companies can choose to exclude leases from the standard, from the balance sheet, if they are 12 months or less, if the lease term is 12 months or less. So there is that option for short-term leases. Also, don't forget the impact on loan covenants and other agreements. Loan covenants, agreements have certain balance sheet ratios and financial metrics in them. Putting all these liabilities and right-of-use assets on the balance sheet could impact those covenants. Those agreements could make a company miss those covenants. So it's important to get out ahead of this, talk to the bankers, talk to others who you have agreements with, and make sure they're aware of what's going on and whether or not some of these covenants might in fact be missed.
And that's a great reminder that this is an opportunity for CPAs to inform and educate lenders about this new accounting requirement, because those covenants are something that I think a lot of entities are going to be worried about as they start putting all of these leases onto their balance sheet. So, make sure that you're working with lenders in the community to help get them up to speed on what some of these most significant changes are.
Yeah, absolutely, Lisa. So, we'll move on here. We've been doing a lot of work, as you mentioned earlier, at the Center for Plain English Accounting on the lease standard, writing lots of technical reports, conducting webcasts, doing customized training to our member firms. And we've been answering lots of technical inquiries, and we expect to be doing a lot of that into 2022 as well. So one of the things we did was we took a look at public companies and what their experiences were when it comes to implementing the new lease standard. And I've listed some observations that we've made, which we think will be helpful to private companies and not-for-profits as they begin their implementation work. And just, you as a reminder here, you can see it on the slide, but we've put one of our reports that we wrote back when companies started to adopt the lease standard. We put that into the resources section, and that can be downloaded as a PDF. So what are we seeing? Well, certainly, as I said earlier, balance sheet impact for all. These leases are coming onto the balance sheet. We're seeing limited income statement impact. As I said, the model income statement wise is pretty close to what we're doing today. So we're not seeing a huge income statement impact. Transition is a challenge. When it comes to adopting the new standard, there are lots of options to choose from when it comes to adoption, different practical expedients that can be selected, and that can be challenging, deciding what would work best for one's company or one's organization. So that can take some work to figure out the transition when it comes to adopting the lease standard. What we did notice is that most public companies that we looked at were adopting what we call the package of 3 practical expedients. So there's a number of practical expedients that are offered. One of them is a package that has to be taken all together, and there's 3 expedients in there, and you can see them on the slide. It's one that you can imagine would be elected, where you do not need to go back and reassess existing or expired leases or contracts to see if they contain a lease. You don't need to go back and reassess prior classifications of leases, and you don't need to reassess the accounting for indirect costs as well. We'll move forward here. Oh, go ahead, Lisa. I'm sorry.
Bob, quick question on that. So basically, to plain English that a little bit more on that practical expedient, is the retained earnings adjustment that you're going to make when you adopt this new standard basically going to be the impact of existing leases that are continuing on past January 1, 2022?
Right.
So
yes.
You can ignore everything that came before and only look at leases that are in effect right now.
Right. And we'll actually get to that on the next slide, where you do have an option for that. So let's take a look there. So other things that we're seeing, we are seeing companies or public companies that we've looked at choose not to segregate non-lease components from the lease components in a contract, except for higher dollar leases like real estate leases. So as an example, you might have a lease of real estate, and there might be non-lease components to that agreement. Perhaps common area maintenance services would be a non-lease component. The new standard allows entities a choice to either segregate or not segregate those non-lease components. Another big area is the discount rate. We're going to have to choose a discount rate when it comes to accounting for leases. The standard requires to use an implicit rate, but very often lessees don't know what the implicit rate is. And we're not seeing with the public companies, many of them use that implicit rate. So that means they need to use the incremental borrowing rate. And that can be challenging, trying to come up with what a company's incremental borrowing rate is. Private companies, they do have an option to use the risk-free rate when it comes to choosing a discount rate by class of leases. So that could be a good option for many private companies. And also, and we're getting to what you just mentioned, Lisa, we're not seeing most companies that we saw readjust or adjust prior periods. So when the standard was initially issued, you had to make a retrospective application. So if you were presenting prior periods in your financials, they had to reflect the new standard. But in 2018, the FASB issued a standard that said, hey, you have an option. You only need to apply the new lease standard on the date of adoption. So that means prior periods in your financials would not need to be adjusted. So that saves a lot of work. So what we'll probably be seeing is many private companies and nonprofits applying this standard as of the adoption date 1/1/22. And finally, just quickly, Lisa, there is a need for lease software. If you have any significant amount of leases at your company, at your client, you're going to find that lease software is needed. I don't think just using an Excel spreadsheet is going to get you there when you have to accumulate all the different data that goes into this. So I'm sure there's a lot of companies out there selling some nice lease software packages these days.
Well, I'm shocked to hear that Excel can't manage all of this, because I just don't know what we do without that. But I get your point, especially for those entities that do have a lot of leases that they've got to track. I can imagine as the entity gets larger and larger, or the type of operation that, yeah, there are quite a few leases. So you've been looking at private company implementation and addressing some of the questions you're getting. So what do you see as some of the biggest challenges?
The biggest one that we're seeing is just identifying the leases that you have. With the prior accounting standard, maybe it wasn't a big deal if you didn't have a handle on all the leases at your organization. But given the fact that now they're going onto the balance sheet, you need to make sure that you are accumulating all the leases out there that might be at your entity. And that means that you might find plenty of contracts, plenty of agreements that might have embedded leases. An agreement doesn't need to say lease agreement at the top of it in order for it to be a lease. There could be a lease in there based on the definition of a lease in the new lease standard. And so, you can imagine that for many entities, this will be a big business process here to try to get controls in place and revamp their processes to make sure that anybody in the organization at all the different departments and geographical locations, when they're entering into agreements, that there's some process in place to capture all that and make sure that if there's a lease involved, that it's getting into the hands of the accounting and finance people so that they can account for it and make sure they've got everything that they need in order to comply with this standard properly.
So, Bob, that's a lot that we've covered. It's a lot to take in right now. So let's look at some of the resources. And before we do that, very quickly, I'm going to just leave you with this slide, because I think that these are going to be great resources for you to refer back to. But as Bob mentioned when we started the section, the time to act is now. And so if we go to the next slide, we'll talk about some of the resources. I noticed a comment in the Q&A before I came on about how to find resources on the site. And so the timing of the slide is perfect. If you go to, let's say you want to learn about leases and you want to see what we offer, go to the AICPA site, put leases in your search term, and then you can filter on that left-hand side of the screen by clicking or unclicking any of those buttons. So if you're not interested in continuing education, then you would unclick the CPE and learning button, and that'll show you the other resources. If you feel like you're ready and you want to take a class, we've got some good ones coming up in January on this topic. So include that CPE and learning button in your radio dial. And then we also have some others that I wanted to point out. The FRC, the Financial Reporting Center, has some resources for you. Bob, as we mentioned, is with the Center for Plain English, which is a firm-based membership section within the AICPA that you can find about at the site there. But I also wanted to take this opportunity as a shout out for a reminder about the Financial Reporting Framework for Small and Medium Entities. This is a non-GAAP basis of accounting that was developed by the AICPA several years ago. And Bob and I actually worked together on this to promote the resources around this. So take a look at that. You're going to hear a lot more about FRF for SMEs throughout the course of the year. And so you'll see Bob coming back to talk more about that.
Well, thank you, Lisa and Bob. Good technical update to close out the year. A lot of comments, a lot of questions coming in. Let's bring Barry Melanson back up for the open forum section. What I'm going to do is just this question came in right before Lisa even gave that highlight of FRF. I'm going to throw it to you, Barry. It's a broad question. Why isn't AICPA putting more of a full court press on FRF for SMEs to fill the gap left by PCC, the Private Company Council under FAF or FASB, in assisting middle market companies?
Well, we do. We're going to actually increase the awareness of. We think things like RevRec and lease accounting, which is really geared to bigger companies, frankly, and not the private companies that many people are servicing here, is a really good alternative. We put a major push on it when it was first developed, and we certainly do have firms that have adopted it. One of the things that firms have been concerned about is, will the bank accept it? And banks are not going to automatically accept it, but if you actually have the conversation with lending officers, et cetera, in whatever banks your clients are dealing with, we have seen that many banks do accept it because you can, as Lisa said, compile, review, or audit against the FRF standard, and it is acceptable in that environment. So I do think when you see these types of changes, it's another opportunity for firms to rethink their support and use of FRF, and we're going to try to help firms think about that in 2022.
Well, Lisa, I know we got a lot of feedback through the Q&A here on the lease overview. Is there anything that you just want to take before we kind of move to year-end closing remarks?
I will be honest, I've been so focused on what y'all are talking about. Bob, I'm going to ask you a question. When you say you're finding very limited income statement impact, do you mean on a net basis, we're just moving the lines between lease expense and interest or right of use amortization? Is that what that is referring to?
Right. Yeah, exactly, Lisa.
So we're just moving the expense in different categories.
Well, thanks, Bob. Thanks for your leadership at the Center for Plain English Accounting. Look forward to having you back many times in 2022 on the town hall.
Thank you, guys.
Thank you, Bob.
Thanks. So what we're going to do now is we're going to talk about some resources, then we'll have some kind of closing reflective remarks. First off, you can, if this is what you want, when you can watch the town halls on archive. One thing I said to Lisa is I don't think we're going to be shooting a town hall next week. Last year we did a special edition town hall. Looks like everything's going to be quiet enough that our next town hall will be January 6th. Lisa, I know you want to highlight this podcast.
Thank you, Eric. So we've talked over the last couple of town halls about 3 IRS revenue procedures that relate to PPP and basis. So that's raised questions from you about when to file an amended return. So the tax section has put out a podcast that's available to all, and it's an interview with Jan Lewis, who heads up our tax executive committee, and it gets into some of the nuances around when to file an amended return and when it might not be the best approach. So I wanted to make sure that you knew about that as you're thinking about the impact of those revenue procedures, and then pull out some of the others that might be of interest to you.
Thanks, Lisa. So here's a quick summary on today. Covered a lot. Opened up with where the Build Better Back is with in the legislative process. So right now, looking at that for potential possible passing in early 2022 to be determined. Great update from Marcy Russell, who will be back with us in 2022, related to where inflation's going, supply chain and employment issues, and just future growth. Lots of really good things to think about as you're having those meetings with your clients, as Barry stated. And then the technical updates, a lot of gold in those slides, and an important review of the new lease standard. So what we want to do now here, just in the closing minutes, is one, really thank you for being part of us with these town halls. You see here on the bottom, this is our 65th edition. Total participation, close to 500,000 watches, 1 million minutes streamed. You have really helped us become more informed about what's going on out there. We work every week to bring you the best available information, working with key stakeholders, working with the AICPA, CPA.com teams. So thank you. And Lisa, what an incredible role you've played with PCPS. So maybe a comment for you, and then I've got a question for Barry to close out.
Thank you. So I just want to take a minute to thank the entire team that you don't get to see on camera every other week, both from the technical standpoint and the logistical standpoint. They get you those newsletters, they get you auto-registered, and they're answering your questions behind the scenes. So thank you to that amazing team. But I'm going to echo Eric's comments. Thank you to all of you who've been participating in these town halls. The feedback has been so rewarding, and it's just been an honor to get to connect with you on a regular basis at such a fun time.
and a lot more to come. So Barry, you've talked about this so much across these 65 episodes. What a defining period we've had for the profession since 2020. Opportunities never been better. The needs have never been better. The purpose has never been higher.
That's right, Eric. And I'd be remiss if I didn't first thank you for driving these town halls. You've done a phenomenal job. And I would echo, Lisa, just so many people have done behind the scenes work to make these work. And then the interaction as I go around, and I have started traveling a good bit now, interacting with members. I hear it, from every different sort of walk of life in our profession. I do think it's sort of funny. If we think back, the message a year ago, it was about how great of a job the profession did and how to leverage that into 2021. And it's sort of hard to believe that we're almost saying the exact same thing today. I mean, the profession has done a remarkable job. I think if you look at the cumulative goodwill of our profession, it has gone up significantly because of the work that we've done in these very trying times for businesses of all shapes and sizes in every industry. And I think the opportunities as we move into 2022 to really leverage that, to a different type of dialogue and work with clients. It does affect our business models as firms. It does affect business models for the clients. These are really, really important issues. We are in a hyper change environment that is not likely to slow down. And our value in dealing with that and being a profession that is adept into those activities, I think will prove huge dividends, including in the pipeline issue, as young people see the purpose of our profession to really keep our economic system, the system that really fuels our country, going well. And the more we can reinforce that, the more attractive we will be, and frankly, the more successful we'll be as a profession.
Thanks, Barry, and thanks for your leadership, which is so well recognized as you travel around the country. So here's where we'll see you next. Look forward to seeing you Thursday, January 6th for the first town hall. Wishing all of you a happy and safe holiday and a great new year.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.